Welcome back to Asia Market Watch, 11:10 a.m. Singapore, Hong Kong time. In our Hong Kong studio, Peter Churchhouse of Morgan Stanley is standing by, and we also have Ben Pedley of Dow Jones Newswires from his office here in Singapore. And we're talking currencies this morning. And Peter, we were talking before about the potential for Europe to start causing trouble in the financial markets. And I just want to revisit that. When I say causing trouble, obviously, what I mean is they're going to object to the fact that they've been carrying the can for the whole global situation. And all I want to know from you is, irrespective of whether Europe sides with Japan or with the US in terms of determining the global currency, is the whole situation right now a stable one? I mean, you know, with this competitive devaluation going on amongst so many of the major nations, and underlying it all, everyone's still relying on the US consumer to pick up the slack for global demand. Is this a stable situation?
That's exactly the point. The world is in a stage of considerable imbalance and has been for about 3 years now, where, as you say, it has relied on the US to be the driver or the main engine of the global economy. However, I do see some light at the end of this tunnel. I mean, we're starting to see a modest pickup in the European economy in the last 6 months. It's very weak, but it is a recovery. It is happening. We're starting to see also in Japan a modest recovery there as well. So you could argue that at the moment that although the US is still probably the strongest major economy in the world of the G7 group, we are seeing a little bit more demand-driven growth in other economies as well. So you could argue that we're in the beginnings of a synchronized global recovery. It's hard to argue that it's completely taken hold yet, but I think it's clear that we certainly are potentially at the early stages of that.
Peter, it's Ben Pedley here from Dow Jones. I'm just wondering, the meeting over the weekend or at the end of last week in Davos really kind of highlighted, I guess, the weaknesses of the whole European monetary union structure, in the sense that we had a variety of comments from a variety of European financial officials saying the euro was either not a worry, or the euro's rise in value was a great concern. We had everyone speaking from sort of the Dutch finance minister, Dutch central banker, going across the whole gamut, the whole spectrum of commentators. Does that ring alarm bells for you? Does that show that there really cannot be policy cohesion coming out of Europe? I'm talking like, not right now, but I'm talking in a longer term sense. Does this ring some alarm bells for you in terms of just the whole EMU structure going forward?
Oh, absolutely. I'm of the view of over the long term that the EMU is going to unravel at some point over the next 10 years or so. You've got such disparate policy objectives across Europe. You've got such disparate fiscal regimes, social programs, pension programs, employment programs, and so on, that it's virtually impossible, I think, to sustain a common monetary policy across Europe without some form of major political unification, which I don't see happening at all. So it doesn't surprise me that we see every single finance minister in Europe perhaps saying something different. So how does the ECB bring all this together and have a coherent policy? It struggles, as we've seen. It has not had a coherent policy. It's very ambiguous. It's very ambivalent in its policy. My sense at the moment is, however, that to address this currency issue, I think the Europeans are going to look to intervention rather than to cut interest rates. And there are a number of reasons for that, but I think that's probably what they're going to do. And as the US economy is picking up, I think there will be a natural easing of downward pressure on the US dollar anyway. So I think it may well balance itself out over the course of the next 6 months fairly nicely.
Well, just to follow up to that, Peter, I mean, okay, you're talking about intervention. What's the trigger point? At what level do the Europeans become so concerned they step into the market and sell euro against the dollar? And I guess in a related question, I mean, we are talking about this potential for unraveling down the track. What could be a potential trigger for some serious rumblings about the whole structure of EMU? I mean, is it going to be Eurozone going into recession maybe in a couple of years' time? Or what's the type of scenario under which you see very overt and very public pressure being placed on the EMU structure?
Well, I think just if we look at the first part of the question first, which is really where the euro is likely to go in the short term, I suspect that if we see another surge in the euro, say up to the high 120s, 129, 130 range, that will be a potential trigger for Europe to act, and the ECB, I think, would potentially take action. We think there's a reasonably high likelihood that over the short term we could see another surge in the euro to that kind of level. That could be the trigger. In terms of the longer term issues, I think what it's going to come down to ultimately is grassroots politics, where people across Europe find that this whole euro thing is not working for them domestically. They see incursions into their own livelihood, the way they live, their cultures, their traditions, and so on. That could actually be the trigger. It's probably not going to come from on high. It's probably going to come from people wanting to just opt out of the system over a number of years. We're a long way from that, but I would see that's the kind of catalyst that could lead to the unraveling. That's probably a sort of a 6 to 10 year event, not something that's in our near-term horizon.
Peter, let's bring it full circle and bring it back to interest rates in the Fed meeting, because if, as you say, we're going to see the dollar strengthening from here or from very near to here, that's going to be the one plank of the US policy against the current account situation removed, right? So we have this global imbalance of which you spoke without the corrective mechanism in place, which has been the US dollar. In theory, perhaps we have less of an incentive for the Asian banks to keep buying US treasuries because they're doing it as a dollar support mechanism. If the dollar doesn't need support, then they don't need to do it quite so strongly. And all that surely will add up to a situation where, with the US financial markets bearing the brunt of all the activity that's been going on, a rise in interest rate pressure in the US is inevitable, surely.
Well, I agree entirely. Interest rates are going to go up in the US, and I think you're going to see it first at the corporate level. Although companies are quite cash rich at the moment in the US, there is a lot of pressure on them for share buybacks, to increasing dividends and so on. There's increasing pressure for capex to boost investment, which has been lagging for the last couple of years or so. So I think you're going to find that demand and supply of capital at the corporate level may come into a little bit of pressure, which is going to lead to corporate interest rates rising first before we see it, if you like, at the government level. But I think that's definitely where we're heading over the course of the next few months. And we're seeing that already. I think most expectations are that the 10-year Treasury by mid-year is going to be somewhere around 5%. So I think there is an expectation that we're headed in that direction. As far as the Asian economies are concerned, I'm not convinced necessarily that the Asian central banks are going to do anything else with their cash but keep it in US dollars to an overwhelming extent. Sure, they may look at a little bit of yen or a little bit of euro, but I think that the US dollar will remain the reserve currency of the world. And I just don't think this is necessarily a support mechanism as such, but it is really the only major choice for these huge reserves that these countries are building up. And thirdly, you may get increased M&A activity into the US as well.
My point on the Asian currency markets, Asian currency support structure actually was simply one of flows. I mean, if the US is going to try and fund itself with more treasury, and the Chinese and the Japanese don't keep buying treasury, they may keep what they have, but the flow is going to be an element in this surely as well. Peter, we'll have to discuss that one next time. I mean, hopefully after tomorrow we'll be a little bit clearer, but given what Alan Greenspan's tendency is, we might not be any clearer than that. But certainly if we do see corporate interest rates rising, we'll be discussing the crowding out theory a little bit more next time we speak. But I appreciate you joining us today. Thanks very much for coming by.